Okay, so you know the rule, right? Everyone in personal finance says it. You need a $1,000 emergency fund. It's that first crucial step. It's the buffer that keeps a surprise car repair or medical bill from turning into a total disaster. It's a rule designed to save you from debt. But what's the rule when a much, much bigger emergency hits? I'm talking about a full-blown stock market panic. Because lately, it feels like every single headline is designed to do just that. So today, we're going to cut through all that noise and find the one rule that can actually save your entire portfolio.
And let's be real, that anxiety you're feeling, it's completely valid. I mean, when you see charts just plummeting like this, you can almost feel the collective panic as people watch years of profits get wiped out in just a few days. It's a gut punch, and it's a totally normal reaction to some of the scariest economic news we've seen in a long time.
You know what's crazy is that this feeling of panic, it isn't new. This quote here, it's actually describing the crash of 1907, a time when the market got sliced in half. But doesn't it feel like it could have been written yesterday? It's like history is echoing, and the sound is getting louder and louder.
And it's not just one single thing. It feels like a perfect storm is brewing. Just look at this. The Fed is hitting the brakes on rate cuts, which messes with inflation and loans. At the same time, conflicts overseas are choking oil production, and you know that's going to hit us at the gas pump and for everything we buy. Your 401k is taking a nosedive, and the housing market is getting weaker. Any one of these is a problem. All of them together? Yeah, that starts to feel like a crisis.
So, how does this all connect? Really, how does a conflict happening thousands of miles away manage to reach out and actually hit your wallet right here at home? Well, it's a vicious chain reaction, and once you see it, it all starts to make sense.
It all starts right here, in a place called the Strait of Hormuz. You have to understand, this is one of the most critical economic choke points on the entire planet. Think of it like a major artery for the global economy. As you can see, a fifth of the world's daily oil and a third of its natural gas has to squeeze through this tiny waterway. So any disruption here, and I mean any, sends massive shockwaves through the whole system.
And this is how those shockwaves turn into a domino effect. First, a conflict flares up near the strait. Boom! Instantly, oil prices go through the roof. And since our entire economy runs on oil, from the trucks that deliver your food to the plastics in your phone, inflation comes roaring back. Now, this puts the Fed in a terrible spot. They're trapped. They can't cut interest rates to help the economy because that would just pour gasoline on the inflation fire. So with all that uncertainty and high rates, the stock market sells off. See? One domino after another.
Okay, deep breath. After that cascade of pretty terrible news, it's totally natural to be asking this exact question. Should you just sell everything? Cash out and wait for this whole storm to just blow over? I mean, really, is it time to panic?
Well, before you answer that, let's just try looking at this from a totally different angle. Because while all of today's headlines feel completely unprecedented and terrifying, history offers a surprisingly calm lesson.
Just take a look at this timeline. The Great Depression, the oil crisis, the dot-com bubble, the 2008 financial meltdown. It seems like nearly every single decade brings a new, terrifying reason for the market to crash hard. These huge, scary drops aren't a bug in the system, they're a recurring feature. They just happen.
Now, I know this slide looks terrifying. It's basically a highlight reel of financial pain. But the thing is, it only tells half the story. The other half, the part that happens after every single one of these crashes, that's the part that really, truly matters. And here it is. This is the other half of the story. This simple chart shows the last 100 years of the stock market. See that smaller red bar? Those are the years of loss. And this much, much larger green bar? Those are the years of profit. So, despite all those awful crashes we just saw, the long-term trend is just undeniably up.
So what does all this data actually tell us to do? Well, it points to a strategy that is so simple, it almost feels wrong. It turns out the smartest investors often win by being, well, boring. Think about it. During a downturn, you basically have two mindsets. On one side, you've got the panic seller. They get scared, they sell at the very bottom, and they lock in their losses. Sometimes they're forced to, especially if they don't have that emergency cash set aside. But on the other side, you have the long-term investor. They just keep buying, ignore all the noise, and actually see the downturn as a massive sale. They get to buy great companies cheaper.
And this isn't just theory. Here's a perfect real-world example. Back in 2011, right after the housing crisis, people were terrified of real estate. The market was a total mess. But that fear is exactly what created the opportunity.
The whole mindset shift is right there in that quote, seeing assets that are really, really, really cheap as an opportunity, not a threat.
So what does this long-term plan actually look like in practice? It's really simple. You invest consistently, and you especially keep investing when markets are down. You make sure you're diversified, you train yourself to ignore the daily drama of the headlines and instead trust the century of data we just looked at. And probably most important, you start thinking in decades, not days.
Okay, this brings us to our final and maybe the most crucial idea of all. We spend so much time and energy worrying about the risk of a market crash. But what if the single biggest risk to your financial future isn't what you think it is?
So what is it? What is the one mistake that can do more permanent damage to your long-term wealth than any crash ever could?
It's this. The biggest mistake you can possibly make is missing the recovery. The real risk isn't being invested when the market drops, it's being on the sidelines, in cash, when it inevitably bounces back.
Because the recoveries, they can be unbelievably fast and incredibly powerful. Just like this quote says, the market's absolute best days often happen immediately after the absolute worst days. If you sell out of panic, you are almost guaranteed to miss that rebound.
Ultimately, every scary headline, every market crash, it really just presents you with this one choice. Are you going to invest based on today's headlines, or are you going to invest based on tomorrow's history books? The headlines change every single day. The data tells the same story decade after decade.